I'm Eric Friedman from Graph Advisors, and this is the early stage forecasting model for pre-seed and seed stage teams. This came about because Jenny Fielding from Everywhere.vc tweeted out and put on LinkedIn and posted on X, do early stage teams need a financial model? I'm of the opinion, and so is she, the answer is unequivocally yes. So we put together the following model that is a pretty simple overview of what a founder can use to show their thinking as they tell their story. So let's dive in. You can grab this model for free at graphadvisors.com, and there's really two parts to it. There's an operating forecast, which shows you all the expenditures by month over the course of the year, and a revenue forecast, which is a view into the products you're selling or subscriptions that you have from customers. This culminates in your costs, the totals, and what your actual burn is on a net basis and on a gross basis. Diving in further, there's really two things to know other than the two parts of the model. One is that everything in yellow is a variable input. Everything in black is a formula. Most people want to show a 1 to 2 year set of projections, and we'll get into why in another set of videos and in our post. But the way to use this model is simple. Let's go through each section. First is the operating forecast. You probably have 1 to 2 co-founders, maybe more, and a few other people working full-time on the team. This means that you can input their base salary. In this case, we've got $125K for an early stage co-founder 1, and we have about 25% of that base salary allocated to benefits, taxes, healthcare, etc. That gives us a total cost of $156,250. Now, amortized over the month, that means that you're going to be spending $13,020.83. The same is true for the subsequent people that are hired full-time, and that gives you a total monthly burn that you can see here. Next is a group of people that might be service providers or contractors, and you can see here based off of a fundraise and when you can hire these people, you might be hiring a designer in month 5, and that person might be getting $7,500 a month. You might be bringing on someone in the accounting world, and that might be $2,500 in month 4, and so on. This gives you a view into what the team costs, what contractors cost, and a clear way to add them up. Next is a whole section. You can add many more things to it. We have a few things in here that we think are a bare minimum. Miscellaneous costs, legal costs, office costs if you have them, followed by G&A, software, hardware, cloud costs. Again, these are your people, these are software, and other things you may have on the table. You can see that there's some larger items in those months, such as a closing cost. We've got here $25K allocated for legal. Finally, we've got advertising and marketing, and we add those up to get your total monthly gross burn. Next up is the revenue forecast. In this case, it's a B2B SaaS company that is selling a product for $200 a month. They have a number of customers already, and they're well on their way to building a venture scale company. This product has 100 customers. The cost of the product is $200. So you see here that 100 customers times $200 gives you that MRR rate. Now, they see a customer growth of 10% month over month. Again, a variable, so you can change the growth based off of what you're seeing. They also have churn, which is no surprise. A lot of people leave this out of the model, but this is a way to tell a story and show an understanding of your thinking. Now, $20,000 a month in MRR sounds great, but what does that look like juxtaposed to your customer acquisition costs and your revenue? Well, in this case, they're spending 50% of that on customer acquisition, which means their revenue is hit by 10K, which leaves you a monthly net revenue of only 10K. So, thinking about what we did in the first section, you have monthly operating expenses of people, contractors, miscellaneous costs and other variable costs, software, hardware, and then advertising and marketing. And that gives you a total monthly operating expense of $93,000. If you factor in your monthly net revenues against that $93,000, you have a monthly burn of $83K. Now, looking at that growth and the cohort analysis of a revenue forecast, you can see what the next year will bring you. So looking at churn, CAC, and growth, you can see that we're very slowly but surely getting to cash flow positive. This is obviously a model, and if you're growing a venture scale company, it might look significantly different. But in this case, you get to a yearly spend of $850K. Now, if you're growing the team, growing expenses, growing your customer acquisition costs, it's highly likely that you'll have a higher spend. And if you double this number, you're somewhere around the $2 million mark. So thinking about this from an early stage team perspective, you might want to raise $2 to $3 million as an early stage team with an OpEx model that supports it. So you can talk through how and why you're going to be building a team and what the expenses look like. Then you can show what the cohort analysis is of growing your software business or growing your products, what the costs associated with those products might be, and then why you're raising the amount of money that you have. Hope this is helpful. Let me know if you want to provide feedback or have any questions. Thanks.